Welcome back to Market on Close. We got about 30 minutes left in the day. Stock's looking good. Big tech doing its job, holding everything together. Let's talk some picks. Let's do some trading. Barry Martin's a portfolio manager at Shelton Capital, home of EQTIX, a Shelton Equity Income Fund. Barry, good afternoon.
Good afternoon, Oliver. Good to be here.
All right, we're all pumped up thinking about volatility, and as an equity income generator, I know you're an options guy too. So what do you think here? We've got a chance for big tech to keep grinding it out?
Yeah, I mean, it's definitely a possibility. But as you know, Ken mentioned earlier, we have a lot of unknowns that's happening right now. We got election coming up, obviously, and we have Fed. There's a lot of debate what they're going to do. Personally here at Shelton Capital, we're thinking we're going to be in a choppy market, and it might be a good time to fade tech.
And you do this through options? Do you buy downside? Do you sell upside?
Yeah, with the mutual fund EQTIX, what we're doing is generating additional cash returns by monetizing the volatility. And we do that by selling covered calls. So what we do is we attempt to generate anywhere between 6 to 9% annualized yield. Currently, right now, we're north of 8%. So we're looking pretty good. Most of our clients do use it as an income strategy because we're paying out this quarterly dividend. But we're seeing a number of clients come our way just using it as a total return strategy because of the risk-adjusted returns. Over the past 3 years, we've had similar market returns with about 20 to 30% less standard deviation. So it's a nice risk-adjusted portfolio.
Okay. If the market explodes to the upside, I guess that's the only situation that's not ideal for you?
Yeah, we underperform. When you're writing covered calls, you have asymmetric returns. So your upside's capped, but you have but you have downside risk. So what you have to do is really manage that downside risk. So we look for equities that have a defensive quality to them, and equities that hopefully basically generate free cash flow and that are more conservative approach. So we don't chase volatility, but if a stock that we own were to appreciate dramatically, we will underperform. To a certain level, but we do get some of that performance.
Okay. I know you've got a specific approach that you think makes sense in Microsoft right now. Take us through the option structure. Where would you be? What strikes? We're happy to follow along.
Yeah. So Microsoft's a pretty good example of a stock that we would like to own, a stock that we trade options around. So, for example, we have Microsoft around 390. And we got a couple events coming up with Microsoft, company-specific events. So we have earnings at the end of the month, I believe on the 30th. And then you have an X date, you have a dividend that's being paid on February 14th. So a good attractive right for us would be a February option. Typically when we're selling options, we'd like to take advantage of time decay and sell those shorter dated. So in this case, you might want to look at, so if, for example, you have 400 shares of Microsoft, we don't necessarily like to sell all 4 calls at once, because with Microsoft, you have earnings coming up. So you're kind of undecided what you want to do, but you own Microsoft and maybe you want to fade it a little bit, maybe take a little off the table. So in our example, we'd like to sell one of the options. So if you have 400 shares, that means you can sell 4 calls. In our case, we'd like to sell 1 call of, let's say, the February 400 options. So in that case, they're paying around $8. So you'll receive, for selling that 1 call, you'll receive about $800 off of your sale. And if you have 400 calls, if you have 400 shares, you also receive 75 cents of the dividend that's being paid mid-February. So you're collecting $1,100 for selling the Microsoft February 400s. Now, if you sell this option, it doesn't necessarily mean that you need to sell the stock at 400 if it ever gets to 400. Let's say it never gets to 400, you collect that $1,100 and put in your pocket, you can do that trade again. But in this case, if you're still bullish on Microsoft and it appreciates to, let's say, 410, you made $20 on 400 shares. So you made about $8,000 on the equity. And then on the other hand, you have to buy that option back. It's $10 in the money. You're likely going to pay $10 to buy it back at expiration. So you're out $1,000. But on the flip side, you generated, $1,100, including the dividends. So even though the stock appreciated $20, you still came up slightly positive.
Nice.
So this is kind of how the trades that we make. So we don't sell all the options at once. You can be selective in what you do. And I think, that annualized trade, it's only 70 basis points, but the trade's over 30 days. So you're making 70 basis points over 30 days. Annualized, that's 8.5%. And that's pretty much exactly what we're looking to do. So because our yield's a little bit north of 8%.
And this is an approach that obviously works if you're a stock and equity-centric investor, but also if you're looking for something other than like a fixed income product to generate yield, especially with the dividend.
Yeah, exactly. Yeah, exactly. So, we're seeing basically the traditional 60-40 portfolio adjusted. So when you look at we're seeing advisors and clients take maybe 10% slice of their equity selection and about 10% of their fixed income selection and moving into a new category. And that's a category we're in, the derivative income space, because it doesn't perform exactly like fixed income and it doesn't perform exactly like equities. So it has this nice little different performance pattern. And when you add it to your overall portfolio, it lowers your risk. So it's a really attractive alternative that we're seeing in today's market.
Nice, like that. All right, an alternative asset class with options, derived income. Thanks a lot, Barry. Good stuff.
Thanks, Oliver. Take care.
You too. Barry Martin. Shelton's Options Strategies, EQTIX, the fund. All right, with a good approach there for Microsoft. A lot of outcomes in which you don't lose money. When we come back, options trade.